Hello, everyone. My name is Greg Phelps, and I am your host to RetireWire University. RetireWire University is part of my blog, retirewire.com, where I discuss a lot of retirement planning concepts and topics and investments and taxes and Social Security and Medicare and all that fun stuff. So RetireWire University, I want to welcome you to my presentation today, which is sponsored by my company, Red Rock Wealth Management. I'm the president of Red Rock Wealth Management here in Las Vegas. And what we're going to discuss today is retirement income planning, specifically your safe withdrawal rate. And we're going to talk about a lot of stuff today. So I'm going to go ahead and dig right in. Got a lot to cover. The very first thing that we want to talk about is effectively, well, what is the safe withdrawal rate? So I'm going to explain what a quote unquote, air quotes, safe withdrawal rate really is. Then we're also going to talk about the sequence of returns risk, which is incredibly important and could be the single largest destroyer of your retirement ever that you could have imagined. So we're going to talk about the sequence of returns risk. Then we're going to talk about the 4% rule. Many of you may have heard, well, just draw 4% or 5% out of your portfolio, you'll be fine. We're going to dissect the 4% rule. And finally, we're going to talk about some adjustments to the 4% rule so you can actually have more money while you're younger in retirement, what I like to call front-loading a retirement. And maybe you have to put some parameters about that or change the way you think about money and investing in retirement. So let's go ahead and dig right in. First of all, going back throughout history, let's kind of discuss how people thought about retirement income. And it was literally two sides of the same coin. People would approach retirement income in one of two ways. And the first way would be, how much can I spend from my portfolio? I mean, I got this IRA and real estate and some investments and a bank account. How much can I spend from my portfolio? Basically, how much is that retirement paycheck, and not die broke? So that is number one. How much can I spend without worrying about dying broke? Then the other side of the coin really is, I know what I want to spend. I love fancy houses, and who doesn't love to go fast in a fancy red Lamborghini and traveling? Got to be first class. Love the dining out. So I know what I want to spend in retirement. I know what my retirement should look like, but I don't know how much I need to save. Now, the former is more of our client base and more probably of you watching this. The former, meaning I have X amount of dollars and I have all this wealth, how much can I spend? That is for most people who are in their late 50s, about ready to retire. We call it retirement transition or pre-retirement planning, or they've just retired and they're trying to figure things out and so forth. This one, as far as I know what I want from retirement, but I don't know how much it takes to get there, that's a little bit more of a younger investor's game, 30s, 40s, maybe early 50s. So you can see, though, that there are two sides of the same coin and just different ways to kind of think about retirement income. So for purposes of our discussion today, we're going to talk specifically about, I have X amount of dollars, I have these accounts, and I've built it up, and I've scrimped, and I've scraped, and I've invested, and I've risked my capital, and now I've got this chunk of money. How much can I spend without worrying about dying broke? Because the truth is, nobody wants to drive across town to borrow money from your kids for a burger or to pay the rent. So now that we're thinking about retirement income from that perspective, if we go back through history, we're going to do a little rewind and go back through history and talk about how people used to get retirement income and how that fit into their plans. And so back in the 50s and 60s, you literally had these bonds, and these bonds would have coupons. And these were physical pieces of paper. And you would literally physically take your scissors, you would clip these coupons, you would take them down to your bank, and you would say to the teller, "May I have my interest, please?" And at the end of the day, your bond would be out of coupons, and you would say, "Can I have my principal back, please?" And so that worked out really well back in the 50s and 60s because you knew what you had to spend. You had your bonds, you had your income, your interest rate that it was paying, that those bonds were paying, and it worked out really well because it was sustainable. There was very minimal inflation, and it worked great up until the 1970s. Because in the 1970s, as you may remember, your purchasing power just got decimated, and it got decimated from outrageous inflation. I mean, we're talking cumulative double-digit inflation. So whatever it took you to, $1 to buy, now it's going to take you a lot more than that single dollar to buy it. And then your purchasing power on top of that, it fell by more than 50% back in the 70s. So those fixed rate coupons, the interest payments that you were getting by clipping those coupons, they weren't worth as much anymore. And that became a problem. And so the solution became, well, let's buy big companies. We don't want to take a lot of risk. We're retired. Let's buy big companies, big blue chip companies, and let's take the dividends and we'll spend the dividends. And so this sounded fantastic because if you think about it, if McDonald's, for example, if their cost of goods that they're going to sell, all the labor and everything that goes into it, if it doubles, well, they're pretty much in a high inflation environment, they're doubling the price of that burger or that Happy Meal or whatever it is. So your profits and the income to you actually stayed the same. It kept pace with inflation, which is one of the biggest risks outside of sequence of returns risk that every retiree is going to face. And so it kind of worked well. In fact, it worked so well that along come the 80s and 90s, and you looked at your accounts and you said, whoa, my dividends actually outpaced inflation by more than 1%. And not only did they outpace inflation by more than 1%, but my stock prices doubled. And so now you sit back and you say, wait a second, maybe you're in your late 70s or 80s or your 90s and you're going, I've got all of this money that I've amassed. I mean, I already worked for it. Then I tried to spend some of it and my accounts did so well, I'm going to die and leave a lot of money behind. And so in the 80s, in the 90s, it turned to, well, why don't we spend some more of this money? Let's spend some capital gains. So, for example, your mutual funds or your ETFs and so forth, most of your investments, they're going to distribute some capital gains. They're going to take some profits at some point, and they're going to give that to you. So the philosophy became, let's spend some capital gains, but not only capital gains, what about the principal? Instead of dying with all of this money and leaving it to our loved ones, hopefully, and alma maters and all the charities and good things, instead of dying with all this money, let's spend some capital gains. Let's spend some of our principal too. We don't want to leave that much behind. We want to enjoy it. I mean, because retirement should be about enjoying all the things that you love the most with the people you care about the most, right? And so then it got really confusing because now we've got bond coupons and we've got stock dividends and we've got capital gain payments or distributions. And then we've got capital gains or principal that you may actually sell. And so it became this kind of confusing nightmare of, well, I want to spend all this stuff and I want to spend as much as I can, but I don't want to risk dying broke. And thank goodness, along came the advent of the spreadsheet. So we could literally say with a computer, now a personal computer back in the 70s, 80s, 90s, and these fancy things we have today that you can actually do this on your phone. So now we look at how much can I spend from the dividends, from the interest payments, from your bonds, from the capital gains, and from the principal, from selling principal. So we took this spreadsheet and we said, hey, let's model some things. Let's try to figure out what the answer is. Let's take a 60-year-old who's going to retire, going to live till 90. Inflation's going to run about 3% a year. It's not unreasonable. Your return on your stock investments is going to be about 10% a year. That's actually going back to the 20s, not unreasonable either, although it's very volatile, obviously. Then you look at your bond returns, and that's about half of your stock returns, your long-term bonds at about 5%. That gives you a 60-40 portfolio, 60% in stocks. It's a balanced portfolio. 60% in stocks and 40% in bonds. It gives you a balanced portfolio that gives you a return of about 8% on $1 million. So let's just see what this looks like. How much can I spend and not run out of money? And the results show you that you can spend about 6%. We're going to talk a lot more about this, so stay tuned. But the results show you that you can spend about 6% of your money and not run out. And here's how it looks. We can see your income starts here, the green line, and that is $60,000 of your $1 million portfolio. By the time you die, you're spending $150,000 a year. But your principal, which starts out at that $1 million, it kind of takes a little bit of a leap up, and then it drops until finally, when you're 90, you bounce the check for your casket, or whatever phrase that you like and you prefer. So that actually seemed to work really well. But the problem was, well, what if I'm on path to have way too much money? Or what if I'm on path to have not enough money and crash and burn before I'm 90 and I die? I don't want to die broke. And then your choices became, as you're modeling these spreadsheets out over the course of time, You can either increase your savings rate or decrease your savings rate if you're pre-retired. You can actually increase or decrease your spending rate to make that money last longer or shorter. You can actually push off your retirement date, again, if you're pre-retired, or you can retire earlier. Or finally, you can't really control this, but if you die sooner, you can spend more. If you die later, you can spend less. So these became the things that you thought about in terms of your retirement income. And obviously the goal for most people is to maybe leave a little something left for your loved ones, but to enjoy retirement. So we wanted to really dial down what can we actually spend without worrying about dying broke. And the real problem became when you modeled these things, your spreadsheets were all over the place because returns are not linear. You have a problem called sequence of returns risk. And it is probably the most devastating thing that any retiree could ever face if it goes against you. You're going to see that here in a second. So what we're going to do is we're going to say, what if you get the same average stock return? You got 10% a year for that 30-year retirement on average, but we're going to switch 4 years. We're going to switch the first 2 years, and we're going to say, what if you earn 20%, and then the last 2 years you earn nothing? And what if in the first 2 years you earned zero on your stocks, just your stocks, not your bonds? They're doing what they were doing. And then in the last 2 years you earned 20%. And this is going to illustrate the sequence of returns risk. Now, if we take 2 bad years early, and just if you want to nitpick my chart here, that's fine. But I actually pull the income out before the year starts, which is more realistic. So that's why it may look a little funky as far as 2 bad years early. So if we take the first 2 bad years and we say that your stocks earned zero, you actually end up dying, or not dying, you end up dying broke, but you end up without money to live on about 6 years before you actually die. So you've got this gap here. That's a big problem. Again, you started with that $60,000. You ended spending $150,000 because we grew that with inflation at 3%, but you're broke and you're 85. And now you're borrowing money from your friends and family to actually live. And that's a problem. And this is the same average return, 10% on your stocks. And stocks are only 60% of the portfolio. That's scary. So this is the sequence of returns problem. And the sequence of returns is compounded because early returns in your retirement, as you're drawing down money, as you're living off of this and enjoying your retirement, it has a profound effect as you go throughout the next 10, 20, and 30 years. So now let's take a look at what if we have 2 great years early and the stocks earn 20% a year for the first 2 years, and then at the end of your life, they earn zero for the last 2 years. And as you can see, you're still the $60,000 up to $150,000 is what you're spending over your lifetime. You start off with that $1 million and you have this nice little run up, and then we kind of peter out, but you end up dying with quite a bit of money. And that even includes the last 2 years where you earned zero on your stock investments. So as you can see, just changing 2 or even 4 years, depending on how you want to look at this in this safe withdrawal strategy, can really knock you off course, or it can give you this amazing retirement where you leave a ton of money and you're getting the same average return. So this is a very scary thing that you must plan for. So let's take a look at another sequence of returns example. If you were to retire in 1969 and you lived through 1999, same 30-year retirement, and you're going to see quickly how powerful the sequence of returns can be. And I told you, and I'm not telling you this, I'm not promising you this because I can get sued for saying this, but this is an illustration. If I told you stocks were going to earn almost 13% a year, your bonds were going to earn over 9%, your blended 60-40 portfolio, and we're using S&P 500 and long-term government bonds. I've seen these studies done a lot of different ways. These are my stats and my spreadsheets, so they're going to be a little bit different, but the concept's the same. And inflation averaged 5.25% roughly. If I told you you're going to get 11.25% return, you'd say, yes, fantastic. I want to retire now because I'm just dominating the inflation rate and my purchasing power is fantastic and I've got these great returns. And so it seems in theory that 30-year period would be fantastic. So how much could you actually spend if everything was so rosy and everything looked so good and you knew you were getting that 11.25%? And it turns out that you can spend about 7.2%. We were talking about 6% before. Straight line numbers, 6%. It basically is what gets you to the end of your 30-year retirement. But because the numbers are so good and they're so much higher and so much more powerful than the inflation rate, you can actually spend 7.2%. And so your portfolio starts off here at the million, and you have this nice little rise, and then finally at the end, you run out of money. But the beauty of it too is you're actually getting a higher income out of this because you're taking 7.2, so 72,000 off the million instead of the 60. But here comes reality. And again, we've already seen real quickly, sequence of returns is scary. Here's the reality. The reality is if you were to have executed this plan that looked fantastic on paper, 7.2% withdrawal rate, you had a pretty bad year right off the bat. 1969, 1970, you lost about 8%. And then it took about 4 years to recover, but you're still drawing income. And then at that point, you now see 73 and 74, and you have this massive market sell-off where literally the market crashed about 45%. So your $1 million just got crushed. And it actually sent your withdrawals, your $72,000 a year that's growing for inflation, it actually sent your withdrawals to over 16% of the portfolio. So you're not taking 4%, you're not taking 6% or even 7%. The market crushed your portfolio. So now you're drawing 16% out of your investment portfolio. And then it took, another 5 or so years, and all of a sudden you're out of money and there's nothing left. And you literally ran out of money at age 72. You retired at 60, you ran out of money at age 72. Now, the sad part about this is you ran out of money 12 years into retirement on a plan where if I showed you 11.25% return with inflation 5.25%, you would say that's going to be brilliant. But you actually ran out of money in 12 years. And the sad part again is you ran out of money in about 1980, 81, somewhere around there. And from 80 to 99, you had amazing stock market returns to the tune of about 14% a year, minus a little glitch, October 1987. You may have heard of that one. Minus a little glitch, but your balanced portfolio, not stocks, your balanced portfolio did tremendously well, about 14% a year for those roughly almost 2 decades. Sadly, you were broke. You had no money to grow over those 2 decades. So now you're in big time trouble. The 7.2%, 72,000, it should have worked. Anybody would look at the math and say, this makes sense. I'm going to execute on this plan. In reality, the sequence of returns, because you had bad years early, it destroyed your retirement. Now, what if you got the same returns, but you got them in reverse? So you started and you actually retired with the returns of 1999. And then you lived through the 90s. And then you lived through the 80s. And all of a sudden, you're about 80 years old, and the decade of the 70s happens. And you're living it in reverse, remember, 79, 78, 77. And I told you, because by the time you're 80 years old, you're pretty much set in your ways. You don't want to change your spending. It's not like you want to go back and be a door greeter at Walmart, right? So, and I told you, inflation was going to go into double digits from 2 to 12%, and it was going to be prolonged, and it was going to be painful. You're going to feel and experience the biggest bear market in history, and the stock market would drop 45% and never recover before you passed away. And you would say, I cannot execute that plan. That scares, that terrifies me. And I would agree with you. And I would say that is terrifying. But let's look at the reality. The reality is because you had good returns the first couple of decades, you had this nice run up. And I'll give you this one. When your portfolio is right here about 10 million or so, and then you have a pretty big sell-off, which in reverse would be 73, 74, 75, right around there. And now you're down to about 8 million. That's scary. You lost 20% of your portfolio. But let me point out that you have $8 million. You're not dying broke. You have 8 times what you started with. And your income, as you can see, this income line is actually not straight. That's because I use the exact inflation factor to calculate your income for the following year. And so by the time you died, you're spending $320,000. You got $8 million, your kids, your grandkids, your alma mater, your church, your synagogue, or whatever it is that you love to be a part of. They're loving getting a little bit of that legacy and maybe put your name on their building. So it may have seemed, as I told you, like the worst time to retire, but in reverse, it was the best time to retire, and you thrived. So let's talk a little bit, now that we've covered the sequence issues, the sequence of returns problems that you face and how critical they are. Let's talk about the 4% rule, because we want to solve this problem. And the problem really is, I have X amount of dollars, how much can I spend, and never worry about running out of money. And so Bill Bengen, and by the way, I want to give ultimate credit to Michael Kitces, to Bill Bengen, to Guyton and Klinger, to Dr. Wade Pfau. They've done a lot of research. They're pioneers. They've come way before me. And I truly respect and appreciate everything that they've done. So I want to give that credit where credit is due. But these are my numbers, and they won't look exactly like theirs. So what Bill Bengen did back in the 90s is he said, well, what was the worst possible time I could retire? Going back, depending on what study you look at, he may have done it into the 1800s. I've got this back here to 26, and it goes all the way to 90. And so we looked at each of these 30-year time periods. That's why it ends at 1990. In 1990, so the 30-year retirement you would have died in last year, 2020. So we look at these 30-year periods and we say, what was the safe withdrawal rate? How much could I have withdrawn and not run out of money? And you'll see this is actually like early 80s, 82. At this point in time, you could actually draw 11%. If you were to retire and you had a crystal ball, again, you'd have to have the crystal ball. But if you were to retire and you had that crystal ball and you knew what the returns were, you knew what the sequence was, you could have spent 11%. Your income, instead of being $40 or $60 or $72,000 a year, could have been $110,000 a year, and you would have been fine. But that kind of brings us to the other eras and the other years where it wasn't so great. And it turns out that if you look, 6%, depending on what research you follow, 6 to 6.5% is about your average withdrawal rate that you can get away with. But the problem with that is you're going to run out of money about half the time, because there's a lot of these time frames where the withdrawal rate was less than 6%. And so again, Bill Bengen said, well, what was the worst withdrawal rate I could have taken and not died broke? And it turns out it was somewhere around here in the 60s, 70s. And the number actually turned out to be 4.1%, which was rounded and rounded. And anyways, long story short, that's what we have as the 4% rule today. It was the worst 30-year period that you could have retired and not died broke if you would have withdrawn that 4%. And so that's the quote-unquote 4% rule that effectively takes into account multiple 30-year periods of sequence of returns risks. Is that right for you? Maybe, maybe not. We're going to talk about some adjustments to that and see if it is. But first, I have a question for you, because we're going to cover this. If you think about what you're going to do in retirement, should you take less investment risk? Meaning, you reduce your amount of stocks in retirement. So you start off with maybe 70% in stocks at age 60, and then at age 70, you're at 60%, and age 80, you're at 50%. Should you take less? Should you take more risk as you age? Meaning you start off with, let's just say 60% at age 60, and at 70, you're at 70, and 80, you're at 80%. Sounds funky, I know. Or finally, should you just have a static allocation, meaning that if you're a 50% stock investor and a 50% bond investor, you just leave that alone until you die? That's the question. So your choices are A, B, and C. I think most people would say that they should get more conservative as they age, and it turns out that's exactly the opposite. A lot of the studies that Bengen did basically showed, again, we talked about the 6 to 6.5% as your kind of average withdrawal rate. Your 4.1 is the safe withdrawal rate, but the optimal balance is between about 40 to 70% stocks. And so if you're in that range, you should be fine. But if you take that range, let's say you're a 60% stock investor, and you reduce your risk, you actually run a higher risk of running out of money than if you increase your risk. Because remember, the sequence of returns, when we took the 2 years that had 0% on stocks, you had a problem. You ran out of money 6 years too soon. But when you looked at if you were to increase your risk, maybe you start off at 50% and increase that to 60 and to 70 and to 80, by the time you're 85, you could have 80% stocks and it doesn't affect you that much because you've only got 5 years left on your life. So that's just a little bit of trivia and a different way to think about it. You don't necessarily want to get more conservative in retirement. You want to at least stay with a consistent allocation between 40 and 70%. If you go over 70% stocks, you're going to have extreme volatility and you're going to run the risk of blowing up your plan with that extreme volatility. If you go less than 40% stocks, you're not going to have enough return to combat the loss of purchasing power due to inflation. So this is kind of your window to consider. Now, there are some things that are going to adjust that 4% rule. We're going to talk about each one at a high level because you kind of understand the 4% rule now. Some of the decreases are fees and taxes and any safety margin you want to leave behind. Some of the increases are value added from an advisor. If you have some risk tolerance in your spending, I'm going to explain GuardRail IncomeMax, which you're going to love here in a second. If you diversify and if you rebalance, and some of the ones that could be positive or negative, your time horizon, market valuations, and possibly inflation. So we're going to cover each of those, and we're going to go through them fairly quick. Otherwise, this will be a 3-hour event. So the very first thing is fees. Any money that you are pulling out of your portfolio and paying to an advisor, an accountant, or whatever, a mutual fund manager, a stock trader, whatever it is, any fees are going to be a drag naturally on your investment portfolio. And so what we found here is that if you take that 6% average withdrawal rate and you lop off fees of about 1%, your safe withdrawal rate drops to about 5.3. And I know what you're thinking. You're thinking, well, I don't need an advisor. I don't need to drop my income from, that 0.7%. We'll talk about that in a second. And that's assuming that there's zero manager added value. But real quickly, a lot of people think, well, if I'm taking 4% as my safe withdrawal rate and I'm paying somebody 1%, that means I'm only getting 3% and they're taking a quarter of it. It actually doesn't quite work out like that. And the thing to remember is that fees are a self-mitigating factor. So as your portfolio drops throughout retirement, your fees drop as well and they become a smaller portion. So it's definitely a factor you need to be aware of. And it's honestly a factor that you need to consider before hiring any advisor. You need to understand, is the juice worth the squeeze? Because if it's not, then don't do it. So fees are a drag. Taxes are a huge drag. And what I mean by this is the study that Bill Bengen did showed that your taxes, depending on your tax situation, it dropped your safe withdrawal rate by about 0.3 to a half a point from that 6 or the 4, whatever you're going to start with. Now, if you're in a more actively managed portfolio where you got a manager that's trading or an actively managed mutual fund, it's going to reduce it by a little bit more. And that could be closer to 0.8, maybe even more than that, because you've got a lot of trades and a lot of taxes that are being generated. The taxes, however, are also self-mitigating. And I'm going to add here that, for example, if all of your retirement stuff is in an IRA, the tax drag could be huge. It could be close to 3/4 of a point. Whereas if it's all in a taxable account, it's probably closer to 1/4 of a point. So, and everybody's so dynamically different. There's no way to give you hard and fast stats or rules on this. But think about if you're pulling money out of an IRA, you're paying a big chunk typically to the government for your taxes because you didn't pay taxes putting it in unless we're talking about a Roth, which has no tax drag. So keep that in mind. There is a very big tax drag. Taxes are always going to be a drag. And everything that we discuss for the purposes of this event is really, we're talking about your gross withdrawal. So if I say your gross withdrawal is 5.2%, that's 5.2% off of your $1 million IRA that you pay taxes on and you get to spend what's left. So we're talking about gross numbers. You get to spend what's left if it's in a taxable account. So the other thing that will decrease your safe withdrawal rate is your safety margin. It's pretty much common sense. It just depends on how much of a legacy, how much you want to leave to the kids or the dog shelter. It depends on how much of a legacy you want to leave behind, because you've got to take those monies and you've got to earmark them and pull them out of the portfolio. That's going to reduce your safe withdrawal rate. You've also got to consider that if we look at that 4% safe withdrawal rate, it's about 96% of the time on all these 30-year periods, you're going to have 100% of your principal left. So the 4% is just that we talk about safe withdrawal rate. That's just so you don't run out of money and die broke. But 96% of the time, you actually have all of your principal left too, and probably more. So keep that in mind when you talk about legacy planning and what you want to hold back for the future. Now, if you were to actually reduce your safe withdrawal rate by 0.2%, so if you went from 4 to 3.8, now you're almost, I'm not going to say guaranteed, there's nothing guaranteed with investments. Now you're almost got 100% assumption of getting all of your principal back. So the safety margin or legacy planning, it's going to reduce your safe withdrawal rate. Now, let's talk a little bit about some of the additions or what can improve your safe withdrawal rate. I mentioned advisors, the fees, they're a drag. There's no way getting around that. All advisor fees are a drag. Our fees are a drag. How we handle that drag is what is important to you, and that's actually what's critical to you. So I'm just going to mention these couple of reports. You can look them up on your own. Morningstar did a report. It was a few years back. It was called Alpha, Beta, and now Gamma. And they effectively said, by doing things like rebalancing asset location, looking at a locate or an asset allocation process within the confines of, do you have annuities or Social Security? How do those fit into the asset allocation program? And in terms of the withdrawals and the spending and where you would pull from where we pull income from an IRA or a taxable account or a Roth IRA or an annuity or any one of those mixes, all of those things, they basically said, if you do it perfect, the average client, the advisor who's doing this is going to add about 1.5% in benefit to you. Now, that doesn't translate perfectly into 1.5% more in your withdrawal rate, but it's just alpha. It's what we call advisor added alpha. And there's a whole lot of tax planning and investment planning that goes into that. And you can actually, like I said, these are the five or six things, actually, yeah, 5 things that they discuss in the report. You can Google that report, Alpha, Beta, and now Gamma. You can find it, or you can ask me for it, and I'll send it to you. If you look at the Morningstar report, the Vanguard report, it's called Quantifying Vanguard Advisors Alpha. So this is Vanguard that's saying, hey, we do all of these things, and if we do all of these things, it should add about 3%. And these things, again, are using low-cost investments. They're similar. 3 of them are exactly the same as the Morningstar report, in my opinion. But we're using things like low-cost investments, keeping expense ratios low, using a broadly diversified portfolio, rebalancing the portfolio, they say adds up to, about 35 basis points a year. Behavioral coaching, that's huge. And most people will laugh at me. I would never do that when the market does this, yet they all do. I know nobody thinks that they're going to do it, but they all do. Asset location means putting your investments in the right accounts to reduce your taxes. For example, if you think about some of the international stock funds, for example, they're very tax efficient. I mean, those accounts should be in your taxable accounts here. If you look at government bonds, corporate bonds, high yield bonds, and those accounts are not as tax efficient. Those should be in your IRAs. So asset location, where you put your investments in the different types of accounts that you have, total return versus income investing. A lot of people chase income versus investing for total return, and your investment spending strategy or your retirement income spending strategy in retirement. All of these things adds up to about 3% in their view. So whether it's 1.5 or whether it's 3, it's advisor alpha that if you have the right advisor, these numbers should be added to your safe withdrawal rate. Now, another thing that's going to increase your safe withdrawal rate is your ability or willingness to take on risk. And what I'm referring to here is we do plans. I'll just explain this real quick. This is what we call a Monte Carlo. The Monte Carlo effectively takes 1,000 different randomizations or trials of your different investment returns that you could see over the next 30 years or your full retirement. And it says, well, maybe year one, based off of your portfolio and your investments, and when you draw the money, year one, you make 8%, year two, you lose 3%, and year four, you make 12%. Whatever the numbers are, it randomizes them. And so instead of just saying a safe withdrawal rate is 4%, because that's just a linear number, this actually looks at your spending, because your spending isn't linear. You may spend $60,000 a year on your needs, but then you've also got maybe discretionary of $12,000 a year. And then you've got maybe a car purchase, and that discretionary might only last for 10 years. Maybe you've got a car purchase of $50,000 every 3 or 4 years. Your spending is going to be lumpy. And that's the beauty of using some sophisticated softwares, because we can actually look at all those lumps. And the lumps aren't just on the spending side, they're on the income side as well. You may be 63 years old and your Social Security benefits might not be maxed out if you take them at 67, but they might be at 70. So you've got that lump. Now you've got a bigger chunk of income coming in later. Then you've got RMDs, required distributions on your IRAs. That might happen at 72. So you've got all of these different lumps, and the software takes that into consideration. And if you're willing to say, I've got a 50% chance of succeeding and not dying broke, yes. It's not most of our clients. It's some people, a few. Then you might be perfectly fine increasing your safe withdrawal rate. It's not safe anymore because now you got a 50% chance of dying broke, but you might be perfectly fine. And according to the studies, you can increase your withdrawal rate from 5 to about 7% if you're willing to have that risk level that you might die broke. Again, I'm not going to spend any more time on this because most of the people watching this aren't comfortable with that 50% risk of dying broke. Then this is my absolute favorite. I call it GuardRail IncomeMax, and I just want to emphasize that there. Guyton and Klinger back, I think in 2000, they said, well, your safe withdrawal rate could go up about 1.2 if you, for example, reduced your spending by 10% under a certain situation or increased it by 10% under a certain situation. Now, the situation is pretty painfully obvious. If your portfolio drops, let's just say you're taking out $40,000 a year, you're using the 4% on the $1 million, and your portfolio drops to $800,000. Well, now your $40,000, whatever year you're doing this, you're going to have increases for inflation. Now your $40,000 is actually a 5% withdrawal. It's closer to 5%. And now that has increased more than 20% of your portfolio. So your withdrawal rate increased more than 20%, because 20% would have been 4.8 of your portfolio. So now you got to say, well, I've got to reduce my spending by 10%. So next year, instead of living off of 40,000, you're going to live off of 36,000. But again, remember that we increased your income to 5.2%. So you're getting more out of the gate already. Now, conversely, if your portfolio grows and that $1 million goes up to 1.3, now your withdrawal rate, that $40,000, is closer to a 3.25%, 3.33%, somewhere around there. So your withdrawal rate has fallen by, actually, I think it might even drop farther than that, closer to the 3%. So your withdrawal rate is now dropped by more than 20%. And so now you get, guess what? You get an increase of 10%. So your $40,000 now goes to $44,000. So these are what I like to call the guardrails. So you think about it like driving down the freeway, and whether there's rocks or cliffs or an ocean, these are the guardrails that you have to live with. And these guardrails are going to keep your plan on track so you never worry about dying broke. But it requires a mindset. And the mindset is your ability to reduce or increase your spending based on certain circumstances. I love this idea. I tell everybody when I retire, if I ever retire, because I actually like what I do, I will use this. I would far rather have, let's just say, a year or a 2 years spending cushion, and then the market's bad, and I'm looking at drawing out money in a year, or let's just say, or 6 months, and I draw out less. and maybe I don't take that trip, or I don't buy quite the fancy car, or we cut back on discretionary expenses, or better yet, I might have had, and this is very common, I might have had 20 years of travel at $1,000 a month, or $12,000 a year. I might have had 20 years of travel built into my plan, and I would look at that and say, I can't travel 20 years, I can only travel 12. So instead of taking a huge reduction in income, I'm going to change my goals that are out there, 10, 12 years, 20 years, because I may never have to change them. The market might very easily bounce back over the next 3, 4, 5 years, putting me over where I could take more money or add those trips back on to my retirement plan. So it's a flexible mindset. You have to be willing to deal with the ups and downs, and have to be willing to change your spending accordingly. But I absolutely love that strategy. Now, most of our clients are not happy with a 50% chance of success. They want more of a healthy balance, and they want to be kind of in this green zone, the confidence zone. So we talked about the Monte Carlo. We know that some of these red lines here, they're failures. They're when you ran out of money. And those are typically when you had bad returns early in retirement. And we know that these green lines here, those are successes. You're gonna die with at least $1 in your bank account or more. And so most people want an 83%. They want to be in that confidence zone. 83 is arbitrary. But most people want to have a good number that they're comfortable with. And then what we do is we actually take and make your confidence zone in the planning software, we make those your guardrails. So if this 83 dropped to, for example, 76, we would say, or have the conversation, we need to readjust your plan. And that Maserati that you wanted to buy in 5 years, it's not a Maserati anymore. Maybe it's a Lexus, and maybe it's in 8 years. Or maybe you had all of these gifts or these bequests in your plan, and you wanted to leave behind $250,000 to friends and family. Maybe that gets off the table for now, and hopefully we can do it as market conditions improve. But we've got to adjust the plan to stay within the confidence zone, so you're within the guardrails. So it's two different ways of using the same guardrail approach. We just like it through the planning process because we can make sure that we can either adjust your plan and all your expenses, or we can take a pay cut for a year or 2 years or 3 years, or we can do a combination of the both. You've got flexibility. Another thing that increases your withdrawal rate, your safe withdrawal rate, is diversification. And what I mean by this is basically we've just been discussing stocks and bonds, a real simple portfolio. Stocks 60%, bonds 40%. But as you add in additional asset classes, you add in commodities, you add in corporate bonds, you add in international, emerging stocks, real estate, big companies, small companies, value companies, growth companies, you add in all of these things. And all of these things counteract each other in various market cycles to some extent. There is a non-correlative factor usually, although sometimes correlation gets very close. So these things are going to reduce your volatility over time, which increases your safe withdrawal rate. So according to the studies, you can actually improve your safe withdrawal rate by about 0.5 to 1% by diversifying and not just having a simple stock and bond portfolio, because you'll have less volatility and less risk over time. Another thing that is going to increase your safe withdrawal rate is rebalancing. And what I mean by this is effectively, as we diversified your portfolio from stocks to bonds to international and real estate, you're going to have those assets that do this. Some are going to be good, some are going to be bad. And rebalancing is the process of selling when things are out of tolerance on the upside and buying when things are below tolerance on the downside. For example, now we're selling a lot of stocks and buying bonds. Back in March during COVID of last year, we were selling a lot of bonds and buying stocks. So we're looking at the tolerances and we're doing the opposite of what the masses do typically. And we're actually buying when most people are selling when things are cheap, and we're selling when most people are buying when things are frothy and inflated. So rebalancing is going to be a plus. Don't know how much because everybody's different, but it's going to be a plus to your safe withdrawal rate. Your time horizon can have a plus or a minus effect on your safe withdrawal rate. And what I mean by that is if your time horizon is shorter, for example, we look here at your time horizon is about 20 years. So maybe you're retiring at 70. You plan on dying at 90. Your safe withdrawal rate goes to about 7.5% because those years of volatility, they shrink. And your retirement or your safe withdrawal rate goes down to about 5.5% if you're going to live 40 years in retirement. Just makes sense, but it's important to note that the upside on living shorter over here is substantially more, exponentially more than the downside. So, I mean, if you're going to live this shorter time frame, you're going to retire late, you can definitely, look at spending more money in retirement. So your time horizon could be a plus, could be a minus, depends on when you retire, how long you're going to live. Another thing that could be a plus or a minus is market valuation. So if you think about where the market is today. By most standards, most people would say that we're overvalued. Most analysts, I don't put too much weight in what they say, but they would mostly say, the Shiller Cape Index and we're overvalued, and the PE ratios and we're overvalued. So if we're historically overvalued, your safe withdrawal rate should drop. And that should get a little bit closer to that 4.5%. If we're fairly valued, and this is just kind of a reference range here, that safe withdrawal rate, it might be normal, maybe about 5%. And then if you're undervalued, for example, if you were watching this and you were retiring in 2008, valuations were very low because everything had sold off and we were in the middle of a massive Great Recession. Your safe withdrawal rate can go up. And the reason is there's not a lot farther it can go down. Of course, we can't predict the markets, but you're already higher in valuation, lower in price. So your market valuations are going to affect your safe withdrawal rate as well. And this one is critical as I kind of get close to the end here, inflation. If inflation, which we had talked about, was 3%, if inflation ticks up just by 0.5 point, you lose about 3 years on your retirement because you're going to have to spend more and more and more. And again, with your spending, typically you're going to spend for a year, then you're going to look at what was the inflation last year, and you're going to change your spending by that amount. So if you're changing your spending by 0.5 point more, you lose about 3 years on your retirement. Whereas if you have or experience in your retirement, in your 30-year period, a lower inflation rate at about 2.5%, you're going to end up having, about half your money left, about $500,000 roughly when you die because you didn't spend as much. So inflation is one of those silent killers, but it could also be really good if inflation is really, really low for your lifetime. At the end of the day, you really need a plan. You need a plan to tie in your assets, your income, your expenses, and your liabilities. Because as I said, the expenses that you're going to have are going to be lumpy. It's not one client out of more than 1,000 people I've worked with in a quarter century. Not one client has just sat off and started to spend $60,000 a year and just spent that $60,000 a year forever with growing at 3%. It's not like that. They'll want to buy a car in 5 years. They'll want to take a trip every 3 years. It's lumpy. And so is the income, and everything else in life is just going to throw you curveballs. And so you need a real plan, like I had shown you, the Monte Carlo, to match all of those lumpy incomes and expenses together and get you to a point where you're comfortable, where you're in the confidence zone, and then you put up the guardrails. So in summary, what we've really learned, I think, and I spent a lot of time on it, is the sequence of returns risk. It's scary. It should be terrifying. I don't think most retirees are even thinking about it, but you really have to have a plan for your early on retirement expenses. It's absolutely critical. The 4% rule is fantastic. It's very robust. It's got some flaws, and it's not perfect, and it's definitely not right for everybody, but it's, when somebody asks me, when I go out to dinner or lunch or whatever, and a friend will walk up and say hi, and hey, how much can I spend off of this, get this money for selling my business, whatever. The blanket answer is typically about 4%. That is a very, very crude, rudimentary answer, but that's the blanket answer. And it is very valuable to have that as a starting point. Your personal safe withdrawal rate could be much higher, much lower. Really depends on you and your lumpy spending. And your plan, it could be 3, could be 6. And I really do love the Monte Carlo projections because they actually take into account all of the variances of the market and your lumpy spending and interest rates and Social Security and Medicare and healthcare expenses, all of those other things. So strongly consider having a real plan run for retirement, and I think you'll be much better off by putting on that guardrail strategy, because at least you'll have a good idea. And the reason the guardrail is so important to me is it allows you to front load your retirement. It allows you to spend a little bit more money when you're 60 and 63 and 68 and 74. And quite possibly you might have to make some adjustments along the way. But it also takes into consideration that, you know what, you're probably not going to spend as much money later on anyway. So it gives you more money early in retirement, knowing that you have the mindset that you're willing to make some adjustments and be flexible. And you're probably going to spend a little bit less later in retirement. I am specifically excluding the massive threat that is medical expenses late in retirement, long-term care. That could be a real killer as well. That also has to be in your plan, though. You have to be able to run those scenarios and say, well, what happens if my spouse needs long-term care for $100,000 a year for 4 years? How does that affect me? So that's a totally separate subject, but that can be a killer late in retirement. Generally speaking, this is a great way to front load your retirement. And so that is my presentation on retirement income planning and safe withdrawal rates, and most importantly, the sequence of returns risk. I hope you enjoyed it. I hope you learned a lot. And please feel free to reach out to me if you have any questions. And stay tuned to RetireWire University, because I'm going to be doing a lot more of these educational sessions. Take care and have a wonderful rest of your day.